Can your insurance policy actually save the planet? Okay, I know, it sounds like a total stretch, right? We usually just think of insurance as a safety net, kind of like a boring necessity, or something we literally only interact with when things go horribly wrong. But what if your policy could actively incentivize a greener, safer, and, well, healthier world? Welcome to This Explainer. Today, we're diving straight into this really fascinating concept of how financial institutions, specifically in the insurance industry, are actively shaping our climate and social outcomes. We're going to break down the exact accounting metrics that prove how insurance is fundamentally shifting from just being a passive safety net into a proactive force for good. All right, let's quickly hit our roadmap for today. We've got 1. The proactive insurance shift. 2. Tracking low-carbon premiums. 3. Rewarding responsible actions. 4. Consumer versus commercial scopes. And finally, 5. Quantifying real-world impacts. Okay, let's dive right into Section 1, the proactive insurance shift, moving from the stick to the carrot. So traditional insurance is strictly reactive, right? It's all about absorbing unexpected economic shocks and handing out financial payouts only after a disaster hits. Basically, it's waiting for the worst to happen. But proactive insurance is a whole different ballgame. Thanks to some incredible advances in tech and product development, this new model is all about incentivizing responsible behavior. It's about preventing risks before they even have a chance to happen. Underwriters aren't just sitting back and absorbing risk anymore, they're actually trying to eliminate it. And here is absolutely the most crucial point. This proactive approach creates what the SASB standard officially calls positive externalities. Now, in plain English, that means they are generating genuine societal and environmental benefits through insurance products that literally encourage safe, healthy, and sustainable lifestyles. So by taking steps to mitigate their own financial underwriting risk, these insurance companies are simultaneously benefiting society as a whole. It's a really fascinating dynamic. Moving on to Section 2, Tracking Low-Carbon Premiums, unpacking metric FNIN 410B.1. Now, what's really interesting here is if you look closely at the SASB standard table under policies designed to incentivize responsible behavior, you're going to spot two very specific metric codes. We're going to focus heavily on these two today just so we can understand exactly how the industry actually tracks its progress and proves its real-world impact to investors. So let's define that first core metric from the table. FNIN4 10B.1. This metric basically says that entities have to explicitly track their net premiums written related to energy efficiency and low-carbon technology, meaning it isn't enough for an insurer to just talk the talk and say they support green tech. No, they have to prove it. They track the actual hard premium dollars flowing in from underwriting these specific sustainable technologies. You might be wondering what actually qualifies under this strict metric. Well, the standard provides some pretty clear examples. First up, renewable energy insurance. This can be anything from protecting solar and wind farms against natural hazards, all the way to literally insuring against fluctuations in the availability of wind or solar radiation itself. Second, it includes energy savings warranties. These ensure the energy savings guaranteed by energy services companies, or ESCOs, when they do building retrofits. And third, it explicitly covers carbon capture and storage insurance. These are the big, tangible projects actively moving the needle on the climate transition. But wait, there is a catch. A very crucial rule here. These premiums must be priced and identified separately in customer billing. This is a super strict transparency requirement. An insurer literally cannot just bundle some tiny green initiative into a massive general commercial policy and claim the whole premium as sustainable. No way. The low-carbon element has to be explicitly separated and identified right there on the client's bill for it to actually count towards this metric. Next up, Section 3, Rewarding Responsible Actions, decoding metric FNIN 410B.2. All right, here's our second metric, FNIN 410B.2. This one requires insurers to provide a discussion of products or features that incentivize health, safety, or environmentally responsible behaviors. This is where the magic happens. This is where pricing structures and policy clauses actively reward positive actions. It's the exact mechanism that turns the entire insurance industry from a passive observer into an active behavioral driver. Let's look at how this plays out in the real world. What are the actual carrots being dangled here? Well, insurers are offering solid premium discounts for things like constructing green buildings or buying alternative fuel vehicles. They'll give you discounts for safer driving habits. But amazingly, it even extends into deeply personal health choices. You can actually get a discount for maintaining a healthy diet, losing weight, or, brace yourself, even giving up your weekend drinks and cigarettes. Your daily life choices literally intersect with your insurance costs. All right, moving to Section 4, Consumer versus Commercial Scopes. Where do these incentives actually apply? So, Metric 2 covers an incredibly wide scope. In the consumer segment, these incentives apply to your homeowner's insurance, your automotive policies, and supplemental health and accident policies. But on the commercial side, it spans casualty policies like liability and workers' comp, commercial property, specialty insurance like crop or marine, and even financial insurance like errors and omissions. The takeaway here is that these behavioral incentives are deeply embedded across almost the entire spectrum of the market, touching individual lives and massive corporations alike. Quick sidebar though. There is one surprising but very important exception in the SASB standard that we definitely need to highlight. Standard health insurance policies are strictly excluded from this specific disclosure scope. Why is that? Well, because standard health insurance operations are covered under a completely different industry standard entirely, the managed care standard. So while supplemental health is included here, your primary standard health insurance reporting is tracked somewhere else. And finally, Section 5, Quantifying Real-World Impacts. Measuring the success of incentives. So how do they prove this works? The SASB standard outlines 3 specific quantitative steps insurers can use to demonstrate their performance. Step 1, they literally count the raw number of policies that actively incorporate these incentive clauses. Step 2, they calculate the total amount of premiums generated directly from those relevant products. And step 3, which is definitely the most important one, they measure the actual social and environmental factors influenced by these products. And what exactly do those measurable real-world outcomes look like? We're talking highly tangible human impacts here. Insurers are looking at hard data, like the verified reduction in car accidents involving their policyholders. Thanks to wearable tech, they can measure the average amount of exercise hours per week logged by their clients, or even track the average amount of weight loss by a policyholder. These aren't just vague, abstract concepts, you know? They are specific, quantifiable data points proving that financial incentives are successfully changing human behavior for the better. So the absolutely crucial point to take away from all this is how everything comes together in this ultimate win-win scenario. On the one hand, you have the insurer's goal, which is simply mitigating their overall portfolio risk. By encouraging you to drive safer or live healthier, they pay out fewer claims and boost their bottom line. But on the flip side, you have the societal benefit. By achieving their financial goals, they're simultaneously generating those positive externalities we talked about, creating a safer, greener, and healthier world for all of us. The math of the underwriter just aligns perfectly with the betterment of society. Which brings us to our final thought for this explainer. We've seen the data, we know the metrics. If your daily habits directly shape your insurance costs, what behavior will you change tomorrow? Really think about your own risk profile and the choices you make every single day. The financial incentives are out there, literally waiting to be claimed by those willing to live a little greener and a little safer. Thanks so much for joining me for this explainer, and keep learning.